Hello, investors. Over the last few days, we have seen a huge amount of volatility hit the stock market. The S&P 500 alone has lost over $5 trillion in market cap in just 2 days, driven largely by tariff threats. And while the headlines are dramatic, it's important to step back and ask, what's really happening here? And what opportunities might this chaos be presenting for us? Yes, investors are panicking, but panic often opens the door to great investment opportunities. Historically, markets overreact to short-term issues, and that overreaction creates discounted assets for those who can keep a clear head. So in this video, I'll walk you through our take on the current situation, what potential outcomes we see, and most importantly, the specific opportunities we believe are worth looking into right now. Stick around. Volatility doesn't have to be scary. You can use it to your advantage, and I'd like to show you how. For quite some time, the stock market has been overvalued, frustrating investors who have been waiting for the right time to buy the top performing companies at reasonable prices. Now that moment may have arrived. Thanks to the recent pullback, valuations on many high-quality stocks have dropped, creating attractive entry points even in some of the most sought-after names in the market. And what's exciting is that we're not only seeing strong fundamental reasons to consider these stocks, but also clear technical signals supporting the idea that now might be a great time to get in. So if you're a more aggressive investor, this could be your chance to start building positions in world-class companies at a significant discount. We've put together a list of 25 stocks we find particularly compelling right now. But let me share just 3 standout examples and explain why they've caught our attention. Let's kickstart the analysis with one of the most well-known stocks in the market right now, Nvidia. You're either an investor in Nvidia or you wish you were an investor in Nvidia after the massive returns it has delivered to investors and the dominance that it holds in the tech and AI marketplaces, to name a few. Nvidia has pulled back 35% from its recent peak, creating what we believe is a compelling entry point. From a fundamental perspective, Nvidia is currently trading at a PE ratio of 34. That's a price to earnings ratio of 34 times. To put this into context, at its peak in 2023, Nvidia was trading at 144 times its earnings. So its PE ratio was 144 times. Today, it is just 34 times. Its 10-year average PE is around 66 times, bearing in mind that back in 2018, we were not yet living through an AI and technological revolution that we're experiencing today. The market conditions and growth potentially now fully justify a much higher multiple than what we're seeing right now. Today's valuation is the lowest PE ratio we have seen since 2018. But we never rely on just one metric when we look at fundamentals. So let's look at the price to book ratio, or the PB ratio, which compares the stock price of the value of the company's assets. Nvidia's PB ratio is currently 31. It has traded as high as 66 times its book value, and its 5-year average is 37.6 times. So currently we are trading at its lowest ever PB ratio over the last 5 years. That suggests Nvidia is now trading at a very reasonable discount compared to its historical valuations. Now, from a technical standpoint, this gets very interesting. Nvidia is sitting right on a major support level, one that has led to a strong price rebound in the past. In fact, the last 2 pullbacks that hit this zone, the stock bounced back with gains of over 49% on both occasions. That's a powerful historic pattern. So what about the elephant in the room, the tariff threats? Here's where Nvidia really sets itself apart. Its profit margins are incredible. 56% profit margin compared to just 6% for its nearest competitor, Advanced Micro Devices, and 25% for Qualcomm. That kind of margin dominance creates a moat, meaning Nvidia has the pricing power and flexibility to absorb rising costs where its competitors might struggle. In our view, this makes Nvidia one of the most attractive large cap names for more aggressive investors that like to buy stocks. And this could be an excellent opportunity right now. Before we look at the other two examples, it's crucial that you understand two things. Yes, tariff threats remain, and markets and stocks could drop further. So having a stop loss or risk management strategy is essential whenever you are looking to buy a stock, particularly in times of volatility. But also, markets are forward-looking. Remember back in March 2020, at the peak of COVID, when we were all in lockdown? The whole world was locked down. Economic data was the worst we had ever seen. There was no vaccine in sight. Yet, in the middle of all of that, the market started to rally extremely aggressively. Why? Because smart money looks past short-term problems and begins positioning when value becomes obvious. By the time the current tariff situation settles, the market will likely have already moved up. You cannot wait for clear skies to take advantage of great opportunities. So now that we've looked at Nvidia, let's turn to the two other names I mentioned, Valley and Himax. And then we'll explore some more conservative ways to take advantage of this market if you're not such an aggressive investor.